Hi there, I'm Blaise Rosser with Keller Real Estate here in Medina, Ohio.
And I'm Tim Davison with CHM Lending, also in Medina.
Today, Tim, what I want to talk about is student loans. I go out and I talk to people all the time that are looking to buy homes, and when you ask them about debt ratios and things like that of what they could afford, revolving credit cards come up, that your car loans come up, your mortgages come up. But rarely do student loans come into the conversation because some reason people look at student loans as they're a different type of debt. Maybe because there's a deferment or something that happens up front. I'm not sure. But from your perspective as a lender, how do student loans play into purchasing a home?
So we look at the credit report, and then we're going to determine, what we're going to use in regards to your debt ratio, your debts compared to your income. So student loans, it's a little complex for a couple of reasons. One, the underwriting rules are continually changing. So Fannie Mae, Freddie Mac, FHA, VA, they're always trying to figure out, what should they be doing, manipulating to make it maybe easier on the consumer or maybe a little bit safer because they don't want to put the consumer in a bad spot. So the underwriting rules are constantly changing on that. So it's hard as a loan officer to stay on top of it. With that said, the first thing we're going to do is look at your credit report and determine, hey, these are deferred. Do we need to hold anything against you? Or hey, they're already making the payment on there. So it really depends on each customer situation.
Well, let's talk about deferment real quick. What is a deferment and what does that mean?
So it means you do not have to make your payment for a set period of time. So let's say you're in school or maybe you just got out of college. The government sets it up to where you do not have to make a payment at all, even though interest is accruing, okay? But no payment out of your pocket until typically 6 months or even 12 months after you get out of school.
And then once they're out of school, those payments, how are they calculated? Is it what they pay on a monthly basis, or do you use a different formula for how you calculate their student loan monthly debt?
Sure. So a lot of times we're set up on an income-based repayment plan to where they look at your income and they say, hey, you know what? Let's not really make the student loan payment $1,000 a month. Let's make it a little more affordable. It's $100 a month or whatever the case may be. Generally speaking, a lender is going to take the loan balance times 1% and come up with their own payment scenario. So it really depends on the customer situation, but ballpark 1% of the loan balance.
And that's what you use as a lender, is that 1%. You don't factor it up or anything like that.
Not in every case, but generally speaking, yes.
Okay, perfect. So with student loans, typically how long is a student loan?
Well, it depends. So sometimes they could be 10, 15, 20 years. They do stick around a while because they tend to be the last debt that's paid, right? If you're a consumer, you're paying high interest rate on a credit card, you're going to pay that off first. If you got your mortgage, you're going to pay. So what I typically see is people making the minimum payments, so those do drag on 10, 15, 20 years.
Okay, perfect. Well, thank you so much, Tim.
Absolutely.